Hello, investors and traders, and welcome to the weekly market report. I'm AJ Monte, and this is a one-year daily candle chart of the Dow Jones Industrial Average ETF, ticker symbol DIA. We talked about the possibility of fan lines breaking in the last live report that we did midweek, and hopefully you had a chance to catch that live report. If not, I'll leave a link in the description box below so you can get a refresher on what Nod and I spoke about this last Wednesday. Today, the markets were jolted by a revision in the job creation report here. You could see that the June total came down from the previously stated 147,000, while the May count fell to just 19,000, so it was revised down by 125,000. The sellers came in pre-market, and then when the markets opened, obviously we gapped down right across the board. And so going back to the daily chart on the diamonds, you could see that there is the gap that I'm referring to right here. And as you can see to the left, we have that target hit at 437.64. Now remember, my targets that I put on these charts are going to benefit the swing traders more so than the long-term investors. And our option traders especially pay very close attention to these targets because, as I mentioned last week, we have an extremely high hit rate with regard to the percentage of targets that are hit. And as of today, because this target has hit right here at 437.64, that brings the hit rate for the diamonds up to 95.6%. Again, you're not going to find that anywhere in the world. And IWM also hit, so we now have a 96% hit rate. 24 out of the 25 targets that was set over the last 12 months have hit. And I still believe that by September and October, we could get that longer term downside target hit, which would bring us to 100%. And it's been a long time since we've had a 100% hit rate. And there's always going to be someone in the crowd that's going to argue, oh, that's not a target hit. Well, it doesn't matter. The price came down to that target. It hit. It doesn't matter this one way down here at 368.12. Doesn't really matter because you're getting 95, 96% hit rate. The option traders are positioning themselves to the downside with option spreads that will be a while before they expire. So you could still have the market go up even with a bearish position when trading options because you have the ability to collect premium in an effort to offset the cost basis. And that's exactly what we do. Maybe next week I'll show you some of the positions that we're working in Eli Lilly, in MicroStrategy. Some of the best positions we have are longer term positions that will expire in 2027. So we have a lot of time to be working those spreads. Now, if you're a day trader and you're setting tight stops for yourself, obviously you're going to get stopped out if the market moves against you. But as I promote in the 1% rule for managing risk, you want to give the market enough room to, as I say, breathe and even allow the price action to go against you without knocking you out into a cash position. And then you turn around and you say, man, I wish I didn't get stopped out. Now the market's moving in my favor. So we cover a lot of strategy here at StickyTrades. I give away what I can on YouTube for free, but obviously we have paying members who pay for this information and they trade against it and they manage risk using these very same charts that I'm showing you here. So what does this mean for next week? Well, with the added volume, and you can see this is tremendous volume today. You can see we have this long stretch of red now, and the oscillators down below are now in an oversold condition. So what I think could happen for next week is I think we're going to see a drop in volume now that the news is out and we've had that knee-jerk reaction to that. In fact, what I'll do is I'll put a line there just as more or less a bookmark to show you what I'm talking about here in the volume. I do believe that we're going to see a drop in volume on Monday and then maybe even a little bit lower as we see some margin selling. We call that margin call Monday. We're going to talk more about that on Wednesday during our next live report. We're bringing on one of our in-house traders, Greg Montwell. He will talk about what the effects of margin will have on the overall market as investors get stopped out or even told to get out by their brokers as the margin calls have to be met. And so we'll talk about that on Wednesday. Don't forget to hit that bell, that notification bell at the very top of the page so that you'll be notified when we start that live broadcast. You're not going to want to miss that one for sure. So it'll be Greg, myself, Nod with his Nod Live reports. And we're having a great time, by the way, on Wednesdays because this is a fairly new broadcast that we're doing and we're gaining some traction with new viewers. And if you go to the YouTube page and you click on the notification bell, which is at the very top right of this page, you'll be notified just before the broadcast starts at the closing bell on Wednesday. And, the analytics that we're getting from YouTube, believe it or not, have told us that only 10% of the viewers have hit that notification bell, which I find to be very surprising. I thought there would be a lot more. So I'm guessing there's a lot of folks that are missing that live broadcast simply because they didn't take their mouse and click on that bell. It's very easy to do. Of course, there's no obligation. It's a free broadcast that we're doing here. But you could absolutely ask us questions. You could submit ticker symbols. If we have time, we'll go over those and help you with regard to risk management, especially when looking at these charts. So what I think we could see, and I go out on a limb whenever I do two-part forecasts, but now that this downside target here has hit, I think we could go just a tad lower on Monday. And like I said, I think we'll see that drop in volume. And then I think we could see a pretty significant bounce up towards this gap fill here. Now, the gap would be filled at yesterday's low, which would be 440.5. So don't be surprised if we see that gap fill or even come close to filling. And then, believe it or not, I think we're going to see another leg lower. What does that look like to you? If you've been following along with our broadcast, you'll know that that is an ABCD pattern. So if we get a bounce on Monday, it would form pivot point B. Then we would see a rally up to C, and a pivot down from C generally leads to a lower D. That's what, again, we refer to as the ABCD pattern. I talk about that quite often. It's something you're going to find on the way up and on the way down. You could see here on this hammer candle, we had a move up. Then we had a pivot lower. Here's B. And then a rally higher from C, which ultimately brought us to a higher D. See, the ABCD pattern works very well both on the upside and the downside. But when you have the markets breaking out below key support levels and below the moving average, like we saw actually happen on Wednesday, and we talked about that, you have to be very cautious if you're thinking about buying into this market. Option traders like we have here at StickyTrades are doing extremely well on the downside, although we're not fully into a negative delta or bearish position. We have a slightly bearish position overall in the portfolio, but as the markets continue to break out below key support levels, we will then add to our bearish option positions over time. And if you want to learn how to do this, listen, it's not rocket science. You could just come on over, take advantage of the 15-day trial for 2 weeks. You can listen to all the recordings, plug into Sticky Trade University, learn how to look at the charts, learn how to manage risk, learn how to position yourself correctly. And that way you won't be stressed out not knowing what to do, especially in a down market. So there we go. I'm doing a two-part forecast. For the record, let me just state the prices here. Downside 433.16. And then what do we have? A possible bounce after the drop in volume to 439.54. All right, so that's DIA. Looking at IWM, here's another one where we hit that downside target right here, and that is giving us the higher percentage on the hit rate. Downside target was hit at 216.91. I think we're going to see the same thing happen. Look at all this red down here. We have 7 red candles in a row. So if we get that drop in volume, and I do think we could go a little bit lower, then after the drop in volume, I think we're going to see a rally. as the bottom fishers continue to buy on the dips. Now notice I'm not going all the way up to the gap fill because this would be a very impressive bounce even if we get up to my upside target of 217.73. So for the two-part forecast, and again, we record this each and every week, downside target hitting first at 212.73, then a rally up to 217.73 again after the drop in volume. Look at the oscillators down here as I back out. Look at what we have. That is the second lowest reading of the year on the CCI, and we're close to about 4 or 5 other times where the stochastic got that low. But the big deal on the stochastic, if you've been paying attention to what I say about these two lines here, the blue line is the percent K. That's the actual stochastic calculation. The red line is the percent D, which is the moving average of the percent K. But when you have these wide divergences, like we see here between the percent K and the percent D, those wide divergences like we see here and even here, once you get the pivot, we generally get a snapback in the price action. Right now, don't get crazy and think, oh man, he's moving out of his perma-bear position and going bullish. No, I'm looking for a bounce, and we could trade those very comfortably, by the way. Many different ways you could trade. You could sell put spreads with limited risk. You could buy calls, longer term calls, maybe into November. You could sell puts in more or less a cash secured put strategy if you have the cash available and you're looking to buy some stocks cheap. You could do that. Again, these are not recommendations. These are just the strategies that we show people in order to be able to bring in cash to their account and still participate in these swings in the overall market. So again, to reiterate, downside target on IWM, 212.73. We'll see the drop in volume, and then we'll see a rally to 217.73, at which time we'll see another ABCD pattern forming. Now, looking at the Qs, this is going to be a little bit different because we don't have a hammer candle here on the Qs. And while the CCI is oversold, the stochastic has not yet gotten to that oversold level. So I am keeping my downside target on the Qs at 546.15. Once that target hits, we'll have to keep an eye on the volume and these oscillators to see if we'll get a bounce. I think there is a possibility in that happening. But you got to understand, the Qs were down almost 2% today, and that volume is extremely high. So on Monday, anyone who's long tech is most likely going to get a margin call if they're leveraged with margin dollars. And it could get to the point where the brokers are going to sell out these accounts because people are not responding to the margin calls. I don't know if you've ever been there. I've never had a margin call in my life because I trade options, limited risk, cash up front. However, for those folks who are leveraged, they're actually stressing out right now because we don't know what's going to happen on Monday. And if you've got a leveraged long position and your broker is trying to get you on the phone or emailing you or whatever else, and you're playing the ostrich strategy, burying your head in the sand, if you don't respond to them and you have a margin call, they're going to sell you out automatically. Some of you know what I'm talking about because I talk to people that have had the brokers sell out of their positions without even telling them sometimes. So the Qs, I think, have a little bit more downside. Again, downside target still open at 546.15. The same thing is happening in SPY. We do not have a hammer candle. We would need a longer shadow underneath that. So my downside target on SPY is 615.26. We would definitely need to see a drop in volume for that market to bounce. And if you look, that's the highest volume read that we've had since March of this year. And so that's point number one. If you look at the SPX, I'm going to throw something on here for you. If you look at the SPX, we talked about this on Wednesday with regard to the fan lines. I highlighted this fan line being the most extreme fan line in the sequence of fan lines. So now the S&P is not only dropping below that fan line, but it's dropping now below the 20-day moving average. And so if I take a step back, look at the weekly 10-year chart, you could see that we have all of these fan lines have been accelerating, with this most extreme fan line in that angle, almost 75, 80 degrees. I'm guessing I don't have a protractor next to me to measure that, but that's an extreme fan line that is the most vertical we've seen in the history of the S&P. Now, what that means, if you're following my fan lines and my rules for fans, there is now an 80% chance that the S&P is going to drop to the next fan line in the sequence, which would be a significant percentage drop here, you see? So don't take my word for that. You go and draw your own fan lines, and I would certainly hope you bookmark or save this link to the recording so that we can go back and review fan lines and how well they work. Now, 80% obviously is not 100% guarantee, but 80% are pretty high odds for you to be able to make money on the way down, especially in the option markets. So that's the S&P. Now, if I go back to the daily chart and I flip to the VIX, again, another target has been hit in the VIX. We talked about this on Wednesday when I started highlighting this inverted hammer down here. Again, go back and listen to that broadcast. An inverted hammer is bullish, and the bullish inverted hammer followed another bullish pattern, which is the bullish engulfing. And then what happened? Yesterday, we had another bullish engulfing with this big green candle engulfing the previous red body. And what happened? Boom, we gapped up on the VIX here. We hit my target precisely. And I was talking about that being, a 30% increase in the price of the VIX from where it was back here on that inverted hammer on Wednesday. And now we have a gap below the market on the VIX. Interestingly enough, what do we have? Now the VIX is caught between two gaps. 100% of the gaps on the VIX fill because it's an oscillating index. It's not a trailing stock. So we have this gap still open at 36.85, which one day will fill. I just can't tell you when, but I think it will. It's a good chance that could happen even by October, mid-October perhaps, as we get into seasonal selling. But like I said before, we now have a gap below the market. So if the S&P starts to drop, the VIX will go a little bit higher. But here's what I'm going to do, because we see this long shadow on top of that VIX. I'm going to go down with the two-part forecast now to fill the gap below the market here on the VIX. That's going to bring it down to around 17. Let me put that exactly at 17 so we can mark that again for the record. Now, if it goes to 17, obviously it's going to fill this gap because the high from this bullish engulfing candle is $17.17. So my target will overlap that gap fill by 17 cents. Then what do I think we'll see? I think we'll see it go right back up and test that high, maybe even blow through that high. Now, again, for the percentage here, for the traders who trade the VIX, that's a nice percentage up and down to be able to get in and out of a position trading the VIX. You could trade VXX, you could trade UVXY. There's different instruments. You could even trade the volatility on IWM through RWM as the ticker symbol there. But staying focused on the VIX itself, downside target 17, a bounce after the gap fill, then right back up to 21. I'll round that to get rid of the pennies because those make me crazy. Sometimes we hit targets and sometimes we miss them by pennies. So downside target 17, then a turnaround to 21. Now, one other thing before we wrap things up, I want to talk about silver, because if you're following me on X, you will have seen me post my trade on silver and what I did. Now, what I normally do is I put the post out on X first, and then I give the market or the viewers 5 to sometimes 10 minutes to trade ahead of me. And if you go and look at some of the reports I have on silver, I was scaling in to a partial position. And I said, when we get the pivot here on this gap fill, hard to see, I'll magnify that. Once we get that pivot, then I would be adding to my long position. Well, guess what? Today is the day that I did that, because what do we have here? We have a pivot. Remember what I was saying about the pennies on the fills? I have a target on SLV at 33. Yesterday's low was 33.10, so it came 10 cents to that low and then bounced. But we do have a pivot here. Look at silver's CCI down there, also pivoting, and we're just having a great time trading. Speaking of trading, what do we have here? The trade of the week. I want to highlight this for you because if you're paying attention to what happened in copper this week, bam, it got smacked because of the tariff news on this industrial metal. And as I was commenting on this on Wednesday, I said that there was still a little bit more room to go on the downside, and we did that precisely. Today, you see that hammer pattern. This is the copper futures for the September contract. I think that you're going to see a pretty tremendous bounce in copper. So I think there's opportunity there. Again, don't take that as a trade recommendation. This is just my analysis of the charts. I think it's way overdone. I think there's going to be big opportunity in copper. And so what we did before this all happened in the sell-off, we put out the trade of the week up 160% on the puts that we put out to our members. And this is exactly what it looked like. On July 9th, a trade publication went out to buy the September 40 puts in FCX, which is a mining company, and we bought those puts for $1. So each option cost $100. That's what we were risking on that trade, not a lot of money. And you can see here that we were risking the entire amount, which was the cost of that option. Well, as of today, those October 40 puts were trading $2.60. And so let's look at this from the very beginning to where we are now so you could track the technical signals and what this looked like. So if I go to FCX on the daily chart, again, looking at the 9th of July, which is right here, what do you see as I magnify that? That is a bearish engulfing candle. So we got long the puts right there. The very next day, it went a little bit higher and displayed a hanging man, which again is bearish. Then what do we see? I just mentioned that earlier, the ABCD pattern. You see that? The top here, pivot is A. We see the pivot on this green candle at B. It pivoted up to C, pivoted down from C, going to a lower D, a lower than B pivot. Now, you may have heard me say this before. I'll continue to say it. If you're a member and you hear me broadcasting about a trade of the week and you're still in it, I'm telling you right now, that trade's done. I just got finished telling you what could happen in the copper markets. And again, I hope people go back and track this because this is all being recorded. Every one of these targets that I put out with these diagonal lines are recorded not just on my charts, but on YouTube and a lot of the other webinars that we record. So everything is verifiable and confirmed. And what I have here in FCX is a possible pivot. We don't have the pivot yet. See, these are all half signals. Even though it's a green candle and this is a hammer, we still have the possibility of a pivot forming. And that's what I did here with more or less a two-part forecast. I think it could start going up. Look down below. The CCI is starting to pivot up. It's coming out of the lowest oversold reading of the year. And like I said before, I think there are opportunities for you to trade in copper, particularly the miners. Now, if you don't want to skip a beat, make sure you go to our YouTube page right there. And at the very top right, there's that little notification bell. Click on that. You could subscribe to our channel. Again, it's free. And you could follow along with these reports. And if you are interested in a 15-day membership, there are no strings attached. I say that so many times. But if you have any doubts about what we're doing, just plug in for 2 weeks. We don't require any credit cards. There's no obligations. You don't have to cancel. It automatically just expires after 2 weeks. Now, if you want to come back, it's totally up to you. But there's nothing you have to do to cancel. You sign up, you plug in, watch the videos. You could ask me questions during the live webinars and then follow along and watch, learn, and do. And hopefully, this is my wish, that you learn this well enough to pass it on to the people you care about most, because no one is teaching anyone at the college level, at even the high school level. No one is offering courses to teach people how to maneuver within this market and make money. This is the place you want to be if you want to learn how to trade and make money in this market. And I thank you so much for liking and sharing and subscribing. We're growing our channel thanks to you. Each and every week we have more people subscribing. And believe it or not, those likes and comments help the algorithms, and it gets put on the menu. Our videos get now posted, and we get a lot of people picking up the link from the menu that you see at the beginning every time you sign on or log into YouTube. So again, thank you for that. Have a great weekend, and we'll talk to you next week. So long.
In a world of endless data, where every second counts, introducing Nod Live, your professional compass in the chaos of the stock market. Nod Live cuts through the noise. Stay ahead with Nod Live.